viewers, we'll be going over the S&P 500 ETF ticker symbol SPY. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for the S&P 500. So back to the technical analysis. Today we're up 1.4% on the 1 hour chart. We are nearing overbought RSI, and for the 1 hour MACD, we may see another convergence and in the continuation to move up higher. As for the 4 hour chart, we are now positive MACD, so we may see a continuation of this reversal, and we have not reached overbought RSI yet on the 4 hour chart. As for the daily chart, if we expand that further, we see a slight divergence in play that was made earlier last week and early this week. And at the moment, we do see a possibility we may even touch the 200-day moving average, this green line, and that is around a price of $303. So we'll mark that as our first immediate resistance. And as for support, if we do manage to reverse and head down lower, the next support level that I see will be around the 18-day moving average, this purple line, and that coincides with the prices of $283.90, and that also matches with previous resistance that dated back to April 17th, and since we're above resistance, that now acts as our support. So if we were to move down lower, that price movement is roughly around 2.6% to the downside, and to the upside, it is around 3% to the upside to hit the 200-day resistance. So let's head to the day-by-day probability model. Again, these models are now available in the link below, so do check it out. So as the days progress to the 7th day, we have a 25% chance for the S&P 500 to climb higher between 2.5 to 5%. On the other hand, we have a 50% chance for the S&P 500 to fall between 0 to negative 2.5. And on the extreme case, we have a 25% chance for the S&P 500 to fall between negative 2.5 to negative 5%. So let's examine the day-by-day forecast for the S&P 500. So we have 1 day out, that will be on Monday, 2 days out will be a Tuesday, and 3 days will be Wednesday. So 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have our current trend. The blue lines are current trend, and overlapping it is the trend that I believe is the best match. And that trend dates back to April 3rd, 2001 to May 16th, 2001. So we have our current trend right here, and below is the trend that I believe is the best match. And let's begin to compare the two charts. So we start off at the bottom Bollinger Band right here, and then we made a reversal to average above the middle Bollinger Band for several weeks. Now the trend in question, we see the same pattern, start off with the bottom Bollinger Band and average above the middle Bollinger Band for several weeks. So we have we also have 1, 2 points. So there's reason to believe if the trends and patterns are the same, the outcome and forecast should be fairly the same. So the model that we just examined was April 17 to June 1st, 2009, or I should say, let's see. Actually, the trend that we just examined was April 3rd to May 16, 2001. Back then, the S&P 500 was down roughly around 74 basis points, so slightly to the downside. So on the 7th day, we see this standard deviation, 50% chance for the S&P 500 to fall between 0 to negative 2.5%. So let's examine the technical performance of each model. So the current trend that we're in is right here. We're only down 60 basis points from monthly high, up 15% from monthly low, up 1.5% from 10 simple moving average, and up 2.8% from 20 simple moving average. And we don't have 50 simple moving average because we're only analyzing a 30-day trend distance. So now the trend that we just examined was April 3rd to May 16, 2011. At that time, it was only 0% from monthly high, up 14% from monthly low, up 2.2% from 10 simple moving average, and up 2.9% from 20 simple moving average. Among the two trends, there are technical similarities. And again, these models are now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.